Mary, feel free to kick it off for us, please.
All right, sounds good. Good afternoon, everyone. Thanks for joining us for another episode of Coffee with Carl. Today, we are excited to have Brad Pineault joining us again from Fidelity Investments. Welcome, Brad. Brad currently serves as the Vice President of Capital Markets for Funds Network and FI product at Fidelity Institutional, FI. Fidelity Institutional is a division of Fidelity Investments that offers investment insights, strategies, and solutions, as well as trading services to a wide range of wealth management firms and institutional investors. And in this role, Brad is responsible for formulating and communicating Fidelity's capital market view to FI's clients in the intermediary channel and has been in the industry since 1998. So thanks for joining us, Brad.
Thanks, Mary. Appreciate it.
Thanks, Mary, for that introduction. Brad, welcome. So let's go ahead and kick this off. It's been a pretty crazy quarter, to say the least. Love to get your thoughts on, what you guys have seen and, how we've come to this, pretty incredible, north of 10% run, on the S&P thus far. And it'd also be great just to highlight, how you guys saw the year starting or, where you guys were positioned as we began the year.
Yeah, I'll tell you, Carl. Well, it's great to be back with you. And Mary, thanks again for the warm introduction. And, what a timely opportunity to talk about the markets, not just where we've been, but, we'll certainly start there as maybe the point of origin. But then we could pontificate on the destination, right? I mean, where are we going? And that's always the fun part, to be a bit predictive. Sometimes we get into trouble, but we have a pretty good handle on how we believe things will shake out. So how do we get here? Well, it's pretty easy to think about why the markets have really run really strongly here. And that's this idea, real simply, that interest rates are no longer going up, right? The Fed back in July tightened for the last time in this cycle. And let's face it, weeks after July of 2023, we didn't know that was the last one. But then in September, the next meeting, when the Fed came out and said, we're not going to tighten in this meeting, then you said, okay, maybe there's some credence to July being the last one. And then the next meeting was November the 1st, right? The Wednesday after Halloween. And they again said, we're not going to tighten, and then so on and so forth. So as we moved away from that July last rate hike, it increasingly became likely, and the probability went up, that the Fed was done tightening rates. So that in and in itself is a really big deal, because let's not forget, back in 2022, when the audience, and thanks so much for tuning in, back in 22, when the market sold off 25%, the simple reason for that was rates were going up and we had no idea, right, how high those rates were going to go. So now we have a really clear idea that 5.5% is the Fed funds rate, right? The prime rate at your local bank is 8.5%, right? These are the high watermarks for this cycle. Now, no guarantee that those numbers can't go higher, but it seems highly improbable that they will. So that's the first point I would make. The second point I would make is, against that backdrop, right, that rates have hit a ceiling, we're starting to see I would say a large number of observations where the economy is actually getting stronger, right? Kind of interesting to think about that. But we haven't had a recession in 4 years, right? A diffuse recession where the entire economy fell apart. But we did have a set of rolling recessions, right? Housing had a recession, 20% off the highs in terms of activity. We know manufacturing had a recession. We know inventories had a recession. We know lending had a recession. We know earnings for the corporate sector had a recession. And all of those, pretty amazing when you think about it, manufacturing just yesterday joining the party, have bottomed and are inflecting higher. So we have a peak in interest rates. We have an economy that's reaccelerating. And most importantly, we have earnings that are expected to be up this year and next year against last year, where they were, slightly down. That's added a lot of fuel and accelerant to this market. And certainly the market is going up in anticipation of, better days ahead. And we could talk about, what interest rates do and whatnot. But that's the simplicity as to why this market has been up as handsomely as it's been in the past really 5 months.
So, if one of the biggest drivers is the Fed stopping, obviously the increasing of rates, and it seems to be, everyone's projecting how many rate decreases we're going to have. Initially it was 6, and now we're down to 3, and now the market seems to be comfortable with 3. What does it look like if we end up seeing 0? Because you're talking about the market, really reaccelerating. So, how does the Fed right that, where we're going to lower rates, but we have an economy that's continuing to be strong, consumer strong, and frankly, with the rise in asset prices, right? I don't see people not spending anytime soon.
It's true, right? I mean, I think what you're getting at is how unusual that we would have a cut in interest rates when, if the economy was a patient, the patient certainly not in the hospital, probably doesn't need medicine. And if anything, they're back up and at it. This economy does not require rate cuts for its longevity to continue. But the question you're asking is more about, well, what do the markets do, right? If the markets have been up as well as they have in anticipation of rate cuts, and the probability of 0 cuts is hardly 0, right? I would say it's probably close. But that would be unusual that we would see that. In fact, we've done work on this. I know you have as well, Carl. When you go back 60 years, there's only really been one period of time. I mean, you could argue 3, where the Fed has loosened monetary policy and has cut interest rates, and the economy didn't require it. The most recent would be 2019. We got 3 rate cuts by Jerome Powell, the current Fed chair, in the summer and the fall. There was no need for it. We got it. I mean, maybe there was a potential trade war with China, but I think the media blew that way out of proportion. That's my own thought. But we got the 3 cuts. And remember, the S&P was up 32% in 2019. What a great time to be an investor. A lot of it, case in part, because the Fed loosened rates. The last time prior to that, 1995, Alan Greenspan was Fed president at the time. Same 3 rate cuts, 25 basis points, 1 in 95, 2 in 96. Stocks were up almost 40% over that period of time. The economy was fine, A-OK. And then the last one, you have to go back to 1967, 67, and nobody really remembers that, right? Because most of us weren't really alive then, and even if you were, you probably weren't thinking too much about it. Point is, same story, right? Rates were cut, economy was fine, markets are up significantly over a 12-month period, almost 30%. So it's not unprecedented that we'd get it, but it's unusual. Here's how I see it playing out. The Fed needs inflation to continue its downward descent, right? Or, continued going down. That's not a guarantee. And what you're starting to hear are different voices within the Federal Open Market Committee, right? Voting members, the people who actually say, hey, yes, I vote for a cut. No, I don't, right? You're starting to see maybe a less homogeneous, right, a concerted effort where some significant voices are saying, hey, there's no rush here. And others are saying, yes, we need to cut. So it will be interesting to see how this reconciles itself. What I firmly believe is that there are certain aspects of this rally in the market that could face some, let's just say, some choppiness here if we don't get the amount of rate cuts that people are hoping. Small caps have advanced pretty significantly relative to large in anticipation of a broadening market. Value, the deeper cyclical areas like commodities, energy, materials, industrials, even financials, if you can believe it. Financials, one of the best sectors, even better than tech, since the November start of this rally, up over 30%. Nobody would, you'd win a bar bet on that one, Carl, because people would say, you serious about that? But those areas of the market have seen a lot of adrenaline here. And I'm just wondering if those areas outside of the large cap growth area, the tech space, the discretionary space, if those areas are catching a bid because of the anticipation of rate cuts, and if they don't come, there will be a period of reconciliation where those names might actually see a significant pullback, and maybe it's the high quality large cap growth that continues to participate here. It'd be interesting to see how that plays out.
You actually hit on interesting point there. We're talking about small caps. I mean, there's been such a lag, when it comes to performance of the small caps and, international, compared with the large growth. If you're an investor, how do you really, how do I, how do you really even consider them? Because you're talking about them potentially selling off again, and I've had this question often when it comes to 401ks where folks just want to put their money in the S&P 500. And if you look at the returns, how does one argue?
Yeah.
Uh, so,
Yeah.
if you're seeing potential weakness there, when are we going to see a time where you actually get the returns in those sectors and really be justified for making those investments?
Well, let me say this, right at the top. There's a lot to play for when investing in small caps, right? There's truly a lot to play for. And defining what I mean by that is you have two unique circumstances with small caps, and I'm quoting the Russell 2000K here, right? Russell 2000. So the Russell 2K, not 2000K. I guess that would be Russell 200,000. But the viewpoint here is when we think about this, the idea is that number one, small caps are trading as if there's a significant hard landing here. And we just don't see it. So they're trading recession-like. And yeah, I guess I get it, right? People thought the recession was coming. It never did. And small caps felt the very brunt of that, expectation. And they're still not as recession-like because they've seen a nice rally here, but they're still pretty wide in their valuation spread. So that's number one. Number two, you have a unique set of circumstances here, right? I would say number one, that things are so bad in small cap that they're actually getting good, right? In other words, you can really see a significant bounce back here to the tune of 40, 50%, right? That's typically what happens at this wide of a valuation lens. And then the catalyst, the accelerant, is the cut in rates.
Yep.
But that is not a big if, but it's still an if. So the way I think of it is you have to go active with small cap. You can't buy an index fund in small cap. Index is fine, right? If you're looking large, because you know what you're buying. In small cap, there's still a number of those constituents that aren't profitable, that really need, right, as a prerequisite, lower interest rates to see their multiples pop or their fundamentals do well. And I don't think that's a guarantee at this at this stage. So the viewpoint here is I still think large caps beat small. I am more considerate of value playing alongside growth, right? Deep cyclicals playing alongside early cyclicals. So I'd be more in tune to add there, right, from the right side of the style map to the left, or depending on how you're seeing me. You get the point there, right? Heading westbound in that style column. But as far as heading southbound to that horizontal, I still like the large cap row over the small cap row because I think small caps do require some macro events to take place. And as much as I am enthusiastic about this reacceleration of economic growth, I am less enthusiastic about a deep cutting cycle on behalf of the Fed. I mean, hey, look, Carl, if the economy continues to do as well as it has, and the Fed does initiate rate cuts, I believe these rate cuts will be short, shallow, and mild. Just like we were talking about the potential for a recession, short, shallow, and mild, the rate cuts will be short, shallow, and mild. So don't expect a deep cutting cycle like we've seen when recessions come our way. Therefore, I don't know if small caps are going to continue to have a protracted bid here. Those are just my transparent thoughts.
Yeah, because I mean, if they did deeper cuts, right? I mean, you're just going to continue to push up asset prices, across, I guess, all asset categories, right? From equities to real estate
to bonds.
crypto. I mean, Bitcoin, whatever it may be.
It would be an everything rally, but it would be for the wrong reasons.
Yeah.
Right.
So, I mean, I think that just leads into the concern, right, of really getting to that, 2% mandate. I guess the question I have for you is, do you see them moving from that? I think that's
Yes.
really one of the bigger, questions, right? I mean, because if they're really settled on 2%, and you really can't cut too deep, right? Because otherwise, we're just never going to get there. Because the economy's got to take a hit. So you're seeing potential for them to shift into the future.
So I'd say yes, is the short answer. The 2% inflation mandate to me was a bit fabricated to begin with.
Yeah.
And that's not just me. We might have even talked about this before. the 2% goal really originated right after the global financial crisis to really give the Fed an anchor to understand, right? Maybe more or less of an anchor, but more of a compass point. Hey, when do we get off of the zero bound interest rates? And we know the story because it's, backward looking. It was 7 years in the making. And even when Chairwoman Yellen of the Fed in December of 15, after 7 years of 0% interest rates, when she took rates from 0 to 25 bips, big deal, inflation was still sub 2. So they hadn't yet hit their 2% inflation goal, but I think they were thinking, hey, we got to start taking these rates up. And they tried. And then, of course, Powell cuts them, 3.5 years later. So, kind of mission not achieved. But to your point, I believe 3 is the new 2. Not just I, but Fidelity believes 3% inflation is the new 2. And the other point I'd make is Powell, the Fed in general, but Powell specifically, has been very clear in stating that they do not need inflation to be at 2 for them to cut. They just have to be confident that they will get to 2. Now, they may never get there, but the confidence is everything, right? If I'm confident that I'm going to do it, I might not achieve it, but that confidence is worth something. And the Fed, Powell in his press conference 2 weeks ago, he said it a dozen times in 38 minutes, we are confident we will get to 2%. And then if you look at their summary of economic projections, which of course is their roll up, this is what their thoughts on paper, it says 2.0% inflation, but not until 2026. So the Fed has given themselves a road of elasticity, right? They don't have to be so rigid where it's 2.0 or bust. They've given themselves 30 months to basically achieve it. 2.0 is their end of 26 goal. So, you got what? Basically 30 months to get there. And that gives the Fed plenty of runway. Heck, 2 years from now, life's going to be a lot different for a lot of us. So, that's the viewpoint there. So we'll see. Maybe I should say this, call. I don't think the Fed will ever come out and say, hey, that 2.0 stuff we were talking about, yeah, that's now 3. If they said that, they'd probably lose some credibility. And of course, if they said that, I think the market goes up 1,000 points in a day because the Fed's there. They could cut at will.
Yeah. So, you're starting to see, obviously the market is taking a little bit of hit today, and, we're up, we're up north of 10%. When looking at capital market assumptions, most firms were targeting 8 to 10% for kind of year-end numbers. And then, and one question I get to is, a lot of folks may be still sitting on some cash, right? And they're earning 5%. And if you look at the run that we've had, what should they do, right? How are you guys, looking at the rest of this year? Are you expecting, even if we don't have any sort of true recession, how are you guys looking at volatility and, potential to the downside, or you guys still, remaining very bullish and think this thing is going to continue to broaden out?
Okay, I'll give you 2 scenarios, and then I'll tell you which one I think wins out. So scenario 1 is what I call the surface current, right? So you look at a body of water, ocean, lake, I guess ponds don't really have much, but lakes and oceans, and there's currents, right? Sometimes it's very tranquil and very serene, and you could, there's nothing there, right? And other times you get some chop. Right now, we have a tranquil body of water. And on the surface, the argument's simple, right? Rates have peaked, they're about to be cut, and they're about to be cut in a very unusual way, meaning they're not being cut because the economy is on fire. There's hardly any smoke, but yet we're still going to get that liquidity. Like I said to one of my clients, picture a fire engine showing up in front of your home, and you're like, "Ooh, that's not good." And then they come out with the softest flow of water just to water your, your flowers. Thank you, right? Especially if you pay for municipal water. That's a gift. That's on the surface. We could possibly get that, and that allows, to your point, almost everything to do well, right? It allows commodities of all shapes and sizes, gold, copper, oil, right? Silver. So precious metals, industrial metals, fossil fuels, they're all up. The dollar is up. Yields are up. We're seeing fundamentals up for the equity market, right? Earnings are expected to be up, margins up, revenues up, jobs still in demand, right? Wages up. It's one of these situations where you say, okay, well, what's not doing well? And there's plenty, but on the surface, this is a very good situation. don't overthink it. Stocks could be up 30, 40% in the next 12 months, even though we've already had this rally. Now, people are growing skeptical of that, as they should, because, wow, how much further can it run? And you talk about 10% year to date. I wrote these numbers down because they're wild. The S&P 500 is up 28.4%. As of Friday, so I guess maybe 27 and a half, right? Maybe today, since November 1st, right? That's really when the Fed came out and kind of implied some type of cut coming up. 28% in 5 months. That doesn't happen all that often. And what I can tell you is when it does happen, right? And when I say not that often, I did the numbers on this back to 1975. 27% returns have only happened 130 times, right? In 50 years of data. And the punchline is after you have that strong rally, you get a 15% move on top of that the next 12 months. So that momentum typically doesn't fizzle out. Now, that's scenario one. Scenario two is what if things are really good, right? And the economy reaccelerates? Maybe, just maybe, that also accelerates inflation. And what that could do is maybe accelerate the probability of less cuts, right? Meaning the Fed says, hey, things are really good here. Labor is strong. Inflation was coming down, but now it seems like it's bottomed and it's coming up. We don't want to be premature about these rate cuts, right? Once the genie's out of the bottle, be careful what you wish for. You can't put it back in, right? So, and by the way, my 11-year-old would tell you, once you take the toothpaste out of the tube, you just can't put it back in, right? I mean, he's actually said that to me. Don't worry, I'll put it back in. I'm like, good luck with that. He's learned not to use as much toothpaste. But so here's the punchline on all this. Which one wins out, right? And by the way, and that one, just to connect the dots one step further, if the economy is too strong and inflation goes up along with it and the Fed gives us less rate cuts, we should be buyers of that market because the fundamentals should be good, right? Again, the economy's too strong, and that actually should be a good market. I'd say either way, this one will have more volatility where less rate cuts are the catalyst for increased volatility. But at the end of the day, if we're 401k participants, what do we care about a month, 2, 3, or 4, even 5 of downside volatility, right? That's when you want to increase your deferrals and get as much money in there as possible to buy those stocks on sale. Yeah. Of course, that takes time to understand, but that's the way you do it. So either way, scenario A, where the Fed cuts and the economy is doing well, stocks are going to do really well. Scenario B, you'll have more volatility, but if you're investing for the long-term goal of retirement, over the intermediate and long term, you'll forget about all of this and you'd be happy that you've invested during that period. So I'd say either way you win. It's just how much do you win by and what's the experience like in the near term? And I think that's what we're trying to figure out.
I guess my next question, curveball, is where do we lose, right? I mean, outside of if they don't, let's say the obvious being if they don't do cuts for inflation really picking back up, are there any areas of the economy that you see weakening and could produce an issue?
Yeah, so I don't know so much if it's the weakening side. Well, let me say this: if there's one area that weakening would be an issue, at least we'd have to really get our arms around it to figure out like what type of ripple effects that loss might have. It would be the consumer. And as you know, Carl, we've been talking about a US-based consumer that's remained resilient in the face of higher interest rates for different reasons, right? Most consumers' debt is tied to mortgages. Mortgages are mostly fixed. So if you have a 3.5% mortgage and mortgage rates are now 7%, what do you care, right? Good for you. You're a have. And if you're someone who wants to borrow to buy a house, you're somewhat of a have-not. Good news is there's a lot more haves than there are have-nots. So we haven't seen a consumer really adversely affected by higher rates, at least not yet. There's still gainful positions in employment, meaning there's more demand than there is supply. That keeps wages elevated. That keeps people, if they want to quit, they can probably find a job of similar compensation and another employer. So those are still good things. But if the consumer were to crack, we'd have to really figure out, how bad that might get for the overall economy and the market. But I'm less concerned about that, and I'm more concerned about what I call right tail events. So I don't want to get too deep here. I know you know this, but for the audience, think about a bell curve, right? And it's a statistical observation. But the bell curve, we call it a bell because it looks like a bell, right? And in the middle is the mean, right? That's the average, and that's where most observations come. But then you have these two tails, and they're called tails because, when the line comes down, the percentage times that those tails happen is very, very, very low. So it's unique. And you have the left tail where things are really negative and really bad. That's like the global financial crisis in 2008. That was a left tail event, and that was ugly as anything, right? Stock market down 50%. Those are awful. But then you have the right tail, and we hardly talk about it, right? Because it's like too positive. But that's the one that I think could be a challenge, because if the economy is too strong, back to the peak interest rate theory, what if I'm wrong, right? Maybe rates have to go higher from here. Now, the economy most likely would be able to absorb that, but the market most likely has a significant sell-off, right? Only because we're just up 28% in 5 months on the expectation the Fed's going to pivot, or at the bare minimum, the Fed is done. And maybe that Fed being done is certainly greater than 0%, right? And I think that's where we have it wrong. You could ask me about government debt. You could ask me about geopolitical conflict like wars. You could ask me about China, Russia. You could ask me about presidential politics. All of these things have the potential to move the market, right? And kind of suck the headlines out of the nightly news or your Twitter feed, right? If we call it Twitter still. I think we do. I don't know. But I don't think they have staying power, right? In other words, those things kind of come and go. Like Trump and Biden, love them, hate them. Those things come in for a few hours, few minutes, and people talk about it, but then it's just poof, what else is going on? And I don't think those really move the market in a protracted way. But the economy being too good, that would move the market if the Fed not only doesn't do zero cuts, but they actually talk about a hawkish hike. I mean, that would really be a eye-opening event. But my probability there is less than 10% for what it's worth, but it's still something to consider.
Yeah, some of those events you mentioned, those are, how would you categorize them? More in the, call it 3 to 5%, move that could potentially be bought up pretty quickly.
Which are healthy. Yes.
Yeah.
Yep. A few statistics for you, and I know you know this, but I think there's a fun to talk about. In any given year, the stock market will give you 3-5% pullbacks. Now, the greatest pullback we've had year to date, 1.4. You can't make this stuff up. So we haven't even had a 5. In any given year, outside of those 3-5, you get 110. And then every 3 years, you get 115. And then every 6, you get a 20%, big old splash. So we haven't even had a 5. As I mentioned, the greatest magnitude down, the deepest pullback, 1.4. Something's got to give. So I wouldn't be shocked if we saw, pretty healthy pullback. And maybe one last statistic, in any given year, the average drawdown is 14%. Now, certainly there are years where 30% skews that number and others that are low, but that's the average drawdown is 14. And then to your point earlier, right, in your first question, the average market appreciation, right, in any given year, S&P 500 is 9%, and we've kind of already checked that box. So to your point, do you kind of take your ball and go and say, well, I got my 9, and now I'll just stay safe for the next 9 months and buy back on January 2nd? Well, yeah, it's tempting. I get it, but no, that's not what you want to do, because then you're just letting your undisciplined nature get the best of you, and that's not a way to invest. So, staying the course proves to be the best way, and I still feel like the market's probability of being up more in 2024 is greater than the probability of it being down for the next 9 months.
Yeah, and I transitioning, I guess, to other segments of the market, called international and fixed income, because I know, for some of the folks too that may be nearing retirement, right? You can't just have all your money in equities and full throttle ahead, so you need to think about fixed income. How are you guys thinking about that market, right? Because if you're sitting on this, if you're sitting over here and you're getting the 5% in cash, or you're looking at your returns in the bond side, obviously they haven't been that attractive, and we're negative again, when we're looking at total bond returns. Now, yet you're getting income in the 5% range, but if obviously inflation reheats, you can lose out there. How are you guys projecting out some of the fixed income space? And then, are there other areas that you guys are looking to for somebody that may be trying to generate some income in their portfolio outside of
Yes.
just pure equity returns?
Yes. So let me say that there's change is afoot, right? So the idea of bonds adding value to a portfolio through better risk adjusted returns, that's still, I'd say, up for grabs. And I'm only saying that not to say that bonds are not worthy of an investment, but they should be thought upon as being a diversification benefit, right? I mean, bonds should give you less downside risk than equities, right? So they should smooth out your portfolio returns, and they should be a nice diversifier against an equity portfolio. And they have been in the past, and I do believe they will continue going forward. To your point, your yield in high quality bonds is 5 to 6%. Your yield in low quality bonds, right? Companies that employ higher debt levels or a certain amount of indebtedness, those are 7 to 8, and really you could say 7 to 10 because there are some parts of that high yield market that are getting you close to 10%. So those are juicy income streams, but I'm not so certain that that will be your area of capital appreciation, regardless of what the Fed does. I just don't see that being the spot. To me, that duration exposure, which should increase your capital appreciation with rates going down, right? Obviously, price goes up. That's optionality, right? Should you get it? Fantastic, right? But I would use it as a peripheral goal, not a core goal, right? Not a core, be more of a fringe benefit as opposed to a core benefit. So with that being said, and by the way, the reason why I say that is I don't see rates coming down significantly, right? Because I don't see a recession. So I actually like equities better than bonds at this juncture, especially for long-term goals. And as far as other areas to maybe get some income, there. So to me, it's still in the fixed income space, but we actually believe that credit exposure is a very prudent way to obtain income. There are other areas, maybe not for conventional 401k plans, like real estate provides income, convertible bonds provide income, but these are less core to a retirement plan set of investment options.
Yeah.
So that's how I think of it. Income is far and few between. I mean, even money markets provide you good income, although those income streams probably have seen their best days only because rates should come down even incrementally. That's probably going to take some of your money market yield away. So, that's how to think of it. So I would say equities continue to be the best opportunity for capital appreciation. And then I would say in the bond space, we continue to like credit exposure, but even the high quality total return strategies, I just think that your risk return or your return per unit or risk profile is going to be more muted than it has been in the past, where bonds were killing it, right, as interest rates continue to come down. And I don't think we're going this way, right? But I also don't think we're going way back down to a zero bound.
Yeah, I mean the credit space seems to be pretty attractive, right? If interest rates end up lingering where they are, you're able to generate that, 7, 8, 9, and upwards of 10% if you go more towards the private side of the house.
Well, I'll tell you, you're right. And if you were to say, okay, tell me more, like what's the bull bear case? The bear case for those types of 7, 8, 9, 10% income streams is if those respective issuers have some type of disruption for them to service their debt. And that disruption would come through an erosion of revenue. And the erosion of revenue would come from some significant disruption to the overall economy. So, taking it the reverse way, if the economy is A-OK, it doesn't mean all these companies are going to do well, right? There's idiosyncratic risks, right, Carl? But if the economy is A-OK, revenue growth is predicated on a strong nominal GDP, right? Revenue growth in decent shape. There's a reason why distress ratios and subsequently default rates remain fairly anemic, right? A bit sanguine. It's because the economy is in decent shape. So I look at that and I say, okay, just like Michael Milken, which I'm sure the audience may not know the name, but Michael Milken, of course, was known as the junk bond king in the 1980s. And he did so well with high yield debt And people would say, "What's your secret?" And he said, "Oh my God, it's so easy. Let me tell you." And he would say, "I buy this bond from an issuer that Wall Street thinks is not going to pay me back, right? They're not going to service their coupon payments. They won't pay back the principal payment. And therefore, they're going to throw a 15% coupon rate, right, on a cost of that debt. And I'm going to take the over on that, right? Meaning I believe they are going to service that debt. And sure enough, right? He was proven accurate, and of course he made a mint. But that's how I see it today, right? I feel like these coupons are probably higher than they should be, but hey, that's okay. I feel like flipping that coupon is a successful strategy, right up against your equity exposure.
Yeah, I think that's we've certainly been in line with that. I mean, I think credit when looking in the fixed income space certainly appears to be, very attractive if you're trying to generate some yield. And obviously for retirement plans, there's different levels of credit you can deploy, but there's still pretty healthy yields in this market. One other area, obviously international sector. Are you guys seeing, what level of opportunity? I mean, when you hear some of the big talking heads out there. I mean, it's been Japan. It's been now I'm starting to hear a little more with regards to India. Where are you guys? And China seems to still be a big question mark. But then you're starting to see maybe some of the contrarian talk with regards to China. What are some areas that you guys see as opportunity? Because again, I mean, more and more participants just say, "Hey, I want to put all of my money in the S&P 500," and I really struggle debating that. If you just look purely at returns over the last few years, and you highlighted potential for the S&P segment to really continue. So, do you guys see any opportunity internationally to provide some outperformance?
So we do. Sometimes the challenge is why bother, right? To your point. And to us, the short answer there is you bother because there's plenty of great companies that are based overseas that in a number of ways have better fundamentals and better stock opportunity for appreciation than maybe their industry related constituents based here in the States. Now, the challenge with that statement is most investors tend to buy international through some type of index product, right? Because it's cheaper, or an ETF product. They typically don't buy those companies directly, right? They wouldn't know maybe how to. And the index and ETF product, because it's mostly cap weighted, you're buying a lot of companies you would never want to own. And you're buying sectors that may not do very well. I mean, consider this. The greatest performing sector in the S&P 500 since 2016, so 8 years now, and we'll see how this year shakes out, has been the technology sector, right? I mean, outside of 22, it's basically led almost every calendar year. Technology is now about 25, 26% of the overall market cap of the S&P 500, right? The domestic index. If you go to the S&P 500 of Europe, right? It's the MSCI EFA in Asia. 7% of that market cap is in tech, right? So you're basically looking at about 20, like a fourth of what we have here. So tech has done well, but here's an index that only has 7%. So which index do you think is going to outperform? Stated differently, if you were to put money into the EFA, just by buying that index, you are maybe inadvertently saying, I don't like technology. I'm betting against it. Let me buy more financials and energy companies that are based in Japan or Germany, right? And they just didn't do very well the past several years. That doesn't mean international didn't do well, right? There were plenty of companies that did well. You just didn't own the right ones. So we are, I would say, encouraged by the opportunities internationally. Japan's obviously been the Cinderella of this ball for 18 months now. Very, very attractive returns for good reason. Japan seems to be surging higher in terms of economic growth. They've just abandoned their yield curve control, their repression of government yields, which should allow them to have even more growth, more domestic investment. We'll see how that all plays out, but you can't deny what's happening in Japan. China, to your point, Carl, is a continued wild card. Sure, stocks are cheap there, but we don't foresee a catalyst that provides an accelerant to cheap stocks. In other words, those stocks probably remain cheap, and maybe you'll see a tactical bounce here or there. But the areas or the idea of China being a secular hold like it was maybe 20, 25 years ago, I think China's best days are way behind it, as I do emerging markets. India sure is catching a glimpse, but Brazil, Russia, these areas used to be the darlings of the investment community. Not so much anymore, right? I think there's some challenges there. So if you only have $1 to invest, or 1,000 or 1,000,000, you really want to put it in an area that seems to be a proven spot. That's why the S&P 500 works. And then active international management would also be a very nice complement to that. You won't believe this if I told you, maybe you would, given what you do for a living. Our very best international strategy has a 15-year track record with the same manager, and that manager is literally about 20 basis points away from the S&P 500's return over 15 years, and he's done it with less downside volatility. People always look at me a little bit cross-eyed and say, "You sure about that? You're not mixing up those numbers?" And no, I'm sure about it, right? And it's because he's active, right? He avoided the companies he thought were going to be worthless. He tried to put more money in those companies and industries he thought, had great brands, great executive leadership, great barriers to entry, and sure enough, great stock price performance. So it can be done, but you have to be very discreet and a bit picky as to what investments you own internationally.
Actually, that brings a good point. So when thinking about maybe more or less the asset allocation side of the house as we finish up, and folks, if you guys want to send in any questions into the chat box, feel free, because this obviously asset allocation drives the overall returns the most, right? So when thinking about maybe international on a 100% equity portfolio, how are you guys allocating that international piece?
Yeah. So, our institutional mandate would tell you it's a 25 to 30% allocation of the 100%, right? Equity sleeve. In some cases, if you're in your 20s and you have a target date fund, I think the new one just rolled out 2070, if you can believe it. When I started at Fidelity, we just rolled out the 2040. Of course, life cycle funds had just come out in 1996, and Fidelity had this 2040, and I was in it. But now that it's the 2070, so sign of the times. But those strategies would have that close to 30% international allocation, and here's why. Starting points matter when you're investing for retirement goals. And as we know, just because one of your participants that you might advise is retiring doesn't mean that you move all your money to cash. So those funds that we have and competitors have, they typically invest through retirement, not to retirement. That's a pretty big observation. And international, as I mentioned, has plenty of good strategies overseas for you to complement what you have here domestically. I understand in 1, 3, 5, even 10-year periods of time, it does beg the question, why bother, right? Just put all your money in S&P 500. Well, maybe one last thought here on the international kind of mandate and topic is the S&P 500 outperformed handedly in a period where interest rates were zero, right? I mean, think about that. And as I mentioned, technology is a bigger part of the index here, whereas financials and industrials and energy companies are the bigger part of the international indices. And when you have zero rates, banks don't make money in zero rates, right? In Japan, when banks went to negative interest rates, I mean, they were paying you, they were supposedly
taking
taking
the money.
Yeah, exactly. But guess what? People in Tokyo said, "I'm not going to give you my money, Bank of Japan. I'm going to go ahead and buy a safe and put it in the safe." I mean, true story, right? You can buy a safe 10 years ago in Tokyo, Japan, because they were sold out. Kind of funny, right? But that's the story. So banks were making no money, and here are some of the biggest companies in the MSCI EFA being Asian banks, right? Well, okay, not going to happen. Those times are behind us. So my point is, I don't believe, no guarantees, but I don't believe the next 10-year period is going to be a carbon copy of the prior 10-year period. Why? Because interest rates aren't zero. And I just mentioned that interest rate cuts will most likely be short, shallow, and mild, right? They are not going to sink like a brick like we saw in 2008 or 2020. So because of that, I think it matters for participants to at least start thinking about international. Maybe it's not everything, but certainly to be complementary to what you're doing here on the domestic side.
Yeah, and I think that's, I think that's very helpful, right? I mean, at least having a consideration, doesn't necessarily need to be 30, 40, 50%, but at least having a diversifier in that, 15 to 25% range can be really helpful.
I
And then
agree.
for some fixed income investors or folks nearing retirement, Brad highlighted a really important area, which is credit. It's oftentimes most folks just think, hey, let me put my money in a bond fund, or they may buy some individual bonds, and it's, more or less very vanilla for their fixed income sleep. So there are other areas, within that market that can generate a lot higher levels of yield, and certainly actually benefit if if the economy continues to be strong. So I didn't see any questions come in. Brad, I won't take too much more of your time. Thanks so much today for going through the markets. This is very helpful. If anyone has any questions on the way out, feel free to reach out to me. Fidelity is certainly a resource of ours. We're glad to connect with Brad and his team and provide any information that you guys do need. So thanks everyone for joining, and Brad, thanks again for your time today.
Great to be with you, Carl. Take care, everybody. We'll hope to see you again.
Cheers. Thanks everybody. Have a great
Thanks.
day.